The stock of the day is brought to you by IG, Australia's #1 CFD provider. Trade over 17,000 markets with extended trading hours on key US shares and competitive spreads, all on an award-winning platform. Get started at IG.com.
And the stock of the day is TechnologyOne. So it saw earnings rise over the FY 2025. Net profit, in fact, was up 17% to $137.6 million. Company saying it's the 16th consecutive year of record profit, record revenues, and record SaaS fees. Revenue increased 18% to $598 million, and it confirmed that it's on track for $1 billion in annual revenue by the 2030 financial year. Investors get a higher full-year dividend of 36.6 cents per share, which includes a 10-cent special dividend. RBC Capital Markets analyst Gary Sheriff says the market expected TNE to beat. It's retained its outperform rating and $45 target price on the stock, saying that the sales pipeline for FY26 remains strong and that it's positioned for profit growth in FY26. Rudi, Filapek, Van Dyke from FNArena, Scott Phillips from the Motley are here to give you their view on the stock of the day. Rudi, you are a happy holder, one would assume, today.
I still wake up every morning with a big smile, but maybe something to point out here is that the market investors always talk about the cycles of markets, and then usually that's connected to economic cycles. But there is a cycle in market sentiment. I mean, and you see, for example, that RBC Capital put a $45 price target on this one. Now that's under the good times. In the bad times, we apparently now, I suspect we have algos going through statements and just trying to see whatever is wrong with results. And as we know, FNArena, we pay a lot of attention to what analysts are updating on companies. And whether it's Life 360, whether it's Aristocrat Leisure, whether it's Zero, and I'm certain I forget a few more. On each of those occasions, you see the analyst reports coming out in the aftermath of the market update, and they're all scratching their heads, thinking like, "Really? Why is the share price down so much?" And I think that's, in the current context, almost like a bear market-like environment for companies that are trading on above average PE ratios, in particular, obviously, when they're AI beneficiaries or growth companies, technology. So I'm going to be very biased here. Yes, I own the shares. I'm now counting myself lucky that I didn't add any more money to the share price when it already had come off quite a lot of the $45 what it was trading at. But I'd be very enticed to take a long-term view here and to add more money.
That's a buy from Rudi. Scott Phillips, Motley buy, hold, or sell for TechnologyOne.
I'm going to upset Rudi. I'm going to sell. Rudi's view on PEs is absolutely valid. The challenge for me is I have less confidence the market's always going to pay overs for TechnologyOne until it can grow at a faster rate. Now, I don't say it's not growing quickly or well. And I said on the call that there's a difference between a company and an investment. And I said about Pro Medicus, you can't fault the company. And TechnologyOne, you can't fault the company. The growth has been astonishing for a really long time. The problem is you're paying at the moment, and maybe after the share price fall a bit less, something around 80 odd times earnings. And I haven't done the numbers since the price fall, so it might be less than that now, but it's going to be 70 plus something times earnings for a business that took 6 years to double its profits. Now, again, that's great, right? Double profits in 6 years is lovely. Does it earn you a PE at that level? No, it doesn't. Mathematically, you can't make it work. So in my opinion, one or two things needs to happen. You either need profit growth to increase even further, or you need the market to always pay a higher PE, a significantly higher PE, and kind of have your value grow with profit growth with no change to the price earnings ratio. Is that possible? Absolutely. But we've seen with CSL and others that when the market all of a sudden goes, yeah, no, not anymore. Then all of a sudden, even if the business continues to perform, a reduction in the price earnings ratio, let's say it goes from 70 to 50, you're going to lose a third of your value close enough to it in that journey, even if the company keeps growing profits. So I just can't, in good conscience, buy TechnologyOne at the current price. I would love to own it at a cheaper price. So I'm absolutely, it's at the top of my watch list permanently. Rudi's made the point before about some great long-term growth companies. TechnologyOne is absolutely that. I just can't pay today's price. We did own it at higher prices. We had recommended our members sell it. Happy that, well, not happy the price has fallen, but happy we've done okay by them by getting out at what we thought was an excessively high price. Now, in the fullness of time, maybe we're wrong. Maybe the price goes back to 60 and I look like a dill. Wouldn't be the first time. So I don't know what happens from here. Probabilistically, I don't want to bet the market always pays a very, very, very high multiple. It'll pay a higher than average multiple, and it should, because it absolutely is justified, but I don't want to pay this multiple. So at a cheaper price, I'm absolutely lining up to buy, probably with Rudi at that point, I suspect. I just can't buy at today's price.
So that is a sell from Scott Phillips at the Motley
for me.
Fool and a buy from Rudi Filapek Van Dijk from FNArena.
The stock of the day was brought to you by IG. Trade over 12,000 shares and ETFs, including major tech giants with extended hours on an award-winning platform. Get started at IG.com.